Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents that companies don't exactly want you to read closely. And today we are diving into Mangoceuticals' recent filing. Spoiler alert, it involves shares, conversions, and maybe a little bit of financial acrobatics. Mangoceuticals just filed a report about selling shares, but not in the usual way. Instead, they converted some preferred stock into common stock. This might sound like financial jargon, but it basically means they're changing the type of ownership some investors have in the company. Let's get into the details to understand why this matters. So on March 25th of last year, a bunch of investors holding what's called Series B convertible preferred stock decided to switch their shares for regular common stock. Think of it like trading in a fancy car for a more common one, but in the stock market. One holder converted shares worth 120 cents per share and transferred into 85,607 common shares at a price of 1.57 per share. Another holder converted shares worth $395,000 into 256,667 common shares, again at that $1.50 conversion price. Then there was a third conversion where 160,667 common shares. The next day on March 26th, another conversion happened where shares worth 239,867 common shares. All these conversions happened under the same $125 conversion price. Mangoceuticals says they didn't have to register these sales with the Securities and Exchange Commission because it was an exchange with existing shareholders, and they didn't pay anyone to make it happen. It's like swapping baseball cards with your friends. Now, what does this all mean? Well, it can change the ownership structure of the company. More common stock means each share represents a smaller piece of the pie. Also, when preferred stock gets converted, it can affect the company's financial statements and how investors see the company's financial health. So what are the strengths and weaknesses of Mangoceuticals' decisions here? The company seems to be streamlining its capital structure by reducing preferred stock, which can simplify things. However, flooding the market with new common stock can dilute the value of existing shares, potentially making each share worth less. A notable risk here is how the market perceives these moves. If investors think the company is just trying to avoid financial difficulties, they might react negatively, which could drop the stock price. In conclusion, these conversions are a significant event for Mangoceuticals. They reflect a strategic decision about the company's capital structure, with potential benefits and risks. Investors should watch how the market reacts and consider the long-term effects of share dilution. Thanks for watching. If you found this breakdown helpful, please hit the like button, leave a comment, and subscribe for more insights into the world of corporate filings.